From 11FS, this is Fintech Insider News, and I am your host, Benjamin Ensor. We've just waved goodbye to today's guests after another show full to the brim with big stories and great conversations. We're covering Alloy's launch in the UK, and we talked about how, with increasing cybercrime and global criminals, it's really important to have strong capabilities of things like know your customer, know your business, and so on. We talked about new regulation plans for buy now, pay later in the UK. And we talked about how these regulations are very welcome because they'll level the playing field and provide more clarity to customers. And if anything, it would be great if those regulations came through even faster. And we talked about, can you talk to your significant other about money? So off the back of a Love Heart campaign by the Canadian Imperial Bank of Commerce, we talked about whether people can or can't have conversations about money with their partners and who they'd like to send a love heart to in the financial services industry. We'll get into all this and much more. But first, a few brief messages. Don't go away.
Hey there, financial risk and compliance professionals. Would you like to know how your peers are preparing for the year ahead? Well, the good news is Comply Advantage's new State of Financial Crime report is built on a global survey of 800 senior compliance professionals, so it provides a clear-eyed look at the views of the financial services industry. To explore trends including environmental crime, crowdfunding, sanctions on Russia, and much more, download your copy of the report at complyadvantage.com/insights.
Here at 11FS, we believe in explaining FS without the BS. That's why we created our 11FS Explore series, videos that break down a complicated financial services topic into something everyone can get their head around, such as
non-fungible tokens,
buy now, pay later, the cost of living,
ESG,
circular economies,
Embedded finance,
and inclusive design.
Search 11FS Explores on YouTube now.
Welcome to episode 708 of Fintech Insider. I'm Benjamin Ensor, Director of Research and Strategy at 11FS, and I'm joined this week on Fintech Insider News by some great guests to break down this week's biggest stories in fintech and financial services. First of all, I am joined by my co-host, who is sitting next to me in the studio, which is always nice, Amy Gavin, Strategy Lead at 11FS. How are you doing, Amy?
Hi, Benjamin. Looking forward to talking through some good stories today. Got some great guests too, so should be a good show.
Without naming any names, are you working on any interesting projects at the moment?
Yes, working on a project for a global card issuer that's very closely related to fintech and how fintechs are, what they want to see, what they need, what they expect. So we're interviewing a load of fintechs to find out more about their jobs to be done at the moment. So that's super interesting.
Fantastic. Okay, well, first of all, we have a welcome return to Fintech Insider for Edwina Johnson, Head of Global at Alloy. Welcome back to the show, Edwina. We'll get to your news a little later, but can you give our listeners a reminder about you and Alloy, please?
Yes, hello. Thanks for having me. So Edwina, I head up global expansion at Alloy. And Alloy is an identity decisioning platform that helps banks and fintechs automate their decisions for onboarding, transaction monitoring, and credit underwriting.
Fantastic. Thank you. We also have a welcome return to Fintech Insider for Douglas Soltys, Editor-in-Chief of BetaKit. Welcome back, Douglas. Can you remind our listeners about you and BetaKit, please?
Yeah, BetaKit is a business publication that covers Canadian tech and tech from a Canadian perspective, and we have a healthy dollop of fintech coverage, which is, I think, why I've been asked to return, and always good to be back.
And we've just demonstrated the difference between the British and the Canadian accent with my inability to pronounce the name of your company properly.
No, we localize in all regions. BetaKit is entirely appropriate depending upon the region. Fully acceptable.
And completing our returning guests this week, we also welcome back Alex Marsh, Head of the UK at Klarna. I think pretty much all of our listeners are familiar with Klarna, but just for those who've been under a rock, can you remind them what Klarna is, please?
Yeah, so Klarna is a payments and shopping disruptor, so particularly well known for buy now, pay later. I was looking back through my notes, Benjamin, so I was last with you almost exactly a year ago, where similarly talking about regulation of buy now, pay later. So it's been quite a journey. It's been a lot of my focus leading the UK business at Klarna for the last couple of years. So yeah, excited to see some developments on that in the past week.
I'll bet. Well, welcome back to all of you. And with that, let's get into the news. So our first story is that US fintech unicorn Alloy is launching in the UK. So this was reported in UK Tech News and various other places. New York headquartered Alloy has launched in the UK, establishing the fintech company's first physical location outside of its home market. Last September, Alloy raised $52 million in Series C capital at a $1.55 billion valuation. The company has created a single API that conducts Know Your Customer and business anti-money laundering and compliance checking for banks and other financial services companies. The fintech will move into a property near London's Liverpool Street station, so quite close to us, where it will have 5 employees. Founded in 2015, Alloy's software is used by over 350 North American banks and fintechs. Edwina, great to have you here for this one. Firstly, congratulations. Are you in London? I'm taking it you're not, because you haven't joined us in the studio.
Oh, I am in London. Yeah, I am. Sorry, I should be in the studio with you.
We've missed a trick there. It would have been nice to have seen you in person. Why has Alloy chosen the UK for its first location outside the States?
Yeah, there are a couple of reasons. So first one is the fintech ecosystem. It's still the second largest fintech ecosystem in the world after the States. And I think, a lot of that's to do with having collaborative regulators that have encouraged the innovation in fintech, but also provided a space for technology to meet those regulations as well. And then, secondly, we work with a lot of multinational fintechs in the States, and one of the first markets that they are expanding into is often the UK. So kind of thinking about helping our existing client base expand. And then lastly, if you're a startup and you're wanting to expand and create a new office in a new territory, then it's always more likely to be successful if you have an early employee base locally and able to support on that.
Definitely. How does financial crime change from market to market? Because I presume that criminals are pretty global and they're pretty quick to copy techniques from country to country. Do you find that your clients are dealing with pretty much the same challenges in market to market, or is there some nuances because criminals kind of exploit regulations, or they exploit certain techniques that are maybe used in some countries and not others? So do you find it's the similar challenges, or are there sort of nuances and differences by country?
Yeah, there's a lot of overlap in fraud behaviors. And I think, some of that came across in a recent fraud report that we did, where we spoke to over 250 people in fraud roles at banks and fintechs, and all of them had experienced fraud. 91% experienced an increase in fraud, and very similar overlaps in the types of frauds that are coming through. Where we might see differences are things like in the UK, the authorized push payment fraud is a much bigger issue here. And that's partly because of real-time payments, and then the banks being on the hook for the fraud costs. And then the fraud being often socially engineered makes it a little bit more tricky. And then when you think about the ID regulations, verification regulations in different markets, there's kind of different trends that have come out. So in Germany, you're going to need the video verification, and in the Nordics, there's more popular uptake of electronic IDs. So then there's different fraud that comes up around those.
Amy, let's bring you into this story. Obviously, cyber criminals are a sort of global, I hesitate to say business, but it's a global operation. But presumably the economic downturn starts, as that starts to push other people into difficulties. Do you think we start to see an uptick in maybe sort of lower level fraud?
I'm assuming the answer to that is yes, because I have certainly seen from the providers that I bank with an increase in communication about fraud scams and warnings to customers that certain types of fraud exist, and helping you to understand what those are, what those mean, what those could look like. Like, for example, I logged into my HSBC app the other day and it was warning me about romance scams, not to be conned into giving anybody money that's trying to message me under the guise of being romantic. So that was one example. But I think financial services companies definitely have a responsibility to look after consumers in this way. And the fact that their communication around fraud has increased suggests that they're seeing more cases of it and wanting to prevent it from their side.
Edwina, are you seeing slightly different patterns of fraud? I mean, does the economic downturn in various different countries around the world, does that sort of obviously trigger, either for people to fall for certain types of fraud or possibly for criminals to, really push particular types of fraud harder?
Yeah, I think one of the things that we noticed is that a lot of the pandemic loans were given out to fraudulent customers, which meant that the fraud ecosystem had a huge venture round of fundraising, essentially. And so there's more bad operators out there that are bringing more people into fraud rings and running more fraudulent activity generally.
Thank you. Douglas and Alex, let's bring you two in on this question of sort of expanding into other markets. Maybe I can come to you, Alex, first on some of Klarna's challenges. Obviously, you're a multi-country, multinational operation, but each time you move into a new country, there's different nuances and so on. What have you sort of learned as a business about moving into new countries? What's easy and what's hard?
Yeah, it's an interesting one. I think so. We've launched 10 new markets in the past 18 months and sort of really ramped up the rate of expansion. I think a lot of the lessons actually from when we launched in the UK all the way back in 2014, we're now able to apply to some of these new markets. So interestingly, from a product perspective, our model is build product global with relatively lightweight localization. So small changes that need to be made, whether that is for very specific kind of local regulation requirements or kind of disclosure requirements. So the product side, actually, we've got working very well. I think one of the lessons from the UK for us has been, and we're applying it now, is to really utilize the ecosystem that's there already available to support you in coming to a market. So whether that's industry bodies and groups, kind of trade associations, like 708 Finance. For us, given our Swedish heritage, actually we've done quite a lot with the Swedish Chamber of Commerce in the UK, who helped us with some of our sort of, whether it was like visa and talent and bringing people across from our HQ in Stockholm to the UK. And actually, I think we did well on that side, but interestingly, engagement maybe into regulators, political stakeholders, media, we came quite late. So we were seeing huge demand from consumers, seeing retailers, we saw really strong growth. Left a bit of a gap, I suppose, in understanding of how our products worked, who was using our products amongst some of those kind of policymakers, for example. And I think that led to some of the challenges where we were almost like playing catch up over the past couple of years to try and educate and making sure, for example, then when they're looking at regulation, that it makes sense. And so going to new markets, that's been something where we're engaging a lot earlier with those groups to make sure they really understand who we are, what we stand for, and the value that we're bringing to people, within that new market or country. So definitely would recommend that to others and utilize groups that can help you build those relationships with policymakers quickly. So rather than kind of, calling, as a new brand, new name that never, haven't heard of, things like industry groups can be amazing for that, where they've already got that network.
Fantastic. Douglas, you've got some world-class tech businesses and fintechs in Canada, firms like Shopify and so on. What lessons have you seen from either from Canadian fintechs sort of trying to expand or succeeding in expanding overseas, or from other businesses sort of launching into Canada from other markets? Have you seen patterns of success, patterns of failure?
It's certainly patterns, not necessarily of success. I think, and I being on the podcast in the past, speaking to this, I think the lesson for Canadian fintech recently has been to not expand overseas or to quickly pull out as soon as possible because it's not gone well for them. I think in the last 2 years, we've seen both Wealthsimple and Clearco completely remove themselves outside of the overseas market. I think Clearco is still operating across North America, Wealthsimple just in Canada. I think for a couple of reasons, mostly because many of the fintechs here are looking to mirror services that are offered elsewhere in the world. And I don't think there's been a long history of a great pathway or pipeline to expand into new markets. So I think what we've seen more here in Canada is global fintech players. Actually, I think wrote a story last year about Klarna coming here and expanding a tech hub in Toronto, like I guess almost a year to the day, strangely. It seems to be a much easier pathway to enter the Canadian market. I think predominantly because Canada is so desperate for competition here when it comes to a variety of financial services. So for Canadian fintech unicorns here, we've been mostly seeing a pulling back for a variety of reasons we get into. Like, I think the global macroeconomic conditions have definitely caused issues, but we're mostly often tracking a variety of global players coming into Canada and offering services that aren't just matched here.
Really interesting. Edwina, I want to bring this story back to you for the sort of final bit, because we started by talking about fraud, but of course that's only part of what you do. Which of the services that you offer, which ones do you think are going to be most immediately successful or most appealing to some of the sort of businesses in Europe? I mean, is it the sort of anti-money laundering capabilities, the compliance checking, the know your customer, know your business? What's your sort of instinct or hunch or fact about which services are proving most relevant to customers on this side of the pond?
Yeah, I think we're seeing at the moment interest across the board, and part of that reason is that we can provide a connected view of identity. So instead of treating onboarding as a separate thing, transaction monitoring as a separate thing, you can start having one view of your customer's identity, no matter where they're at in the journey, and then making smarter decisions on that and seeing a trend for people who want to have that view.
Very interesting. It ties into the work you've been doing, Amy, thinking about business onboarding. Okay, well, you two should have a conversation later. All right. So our next story was reported in Reuters and other media, which is that Britain has set out legislation to regulate buy now, pay later credit. As Alex alluded to earlier. So Britain is setting out draft legislation to regulate buy now, pay later credit, saying the sector poses potential harm to consumers without thorough affordability checks. Buy now, pay later, or BNPL products are largely unregulated and typically offer on-the-spot interest-free short-term loans that spread payments for retail goods like clothing. The sector nearly quadrupled during the pandemic in 2020 to £2.7 billion, or $3.28 billion. It's an unnecessarily precise figure from me there, sorry. The Finance Ministry, the Treasury, said it will launch a public consultation to take on legislation to regulate buy now, pay later, giving the Financial Conduct Authority, the regulator, powers to authorise operators and their activities. Alex, obviously it makes sense to come to you first on this. This has been a sort of ongoing topic of debate, as you pointed out earlier. What role is Klarna and the other buy now, pay later players going to play in this consultation?
Yeah, so I mean, we'll obviously be active in the consultation. I think if you rewind all the way back, so when the FCA initiated the Willard Review, which incredibly, I think they initiated it in September 2020, and that came out in Feb 2021. And I think, to be fair, that set the tone for what has been, both from the Treasury and the FCA, 2 years of very close engagement, and really taking on board the view of both disruptors coming in like ourselves, but also incumbents, industry groups, consumer groups. So I think I think that has been a positive over the past couple of years. And Klarna, this next stage now, where it's getting down into the detail of the specific rules, will be continue to work closely with Treasury and the FCA. I think it's been an element of frustration for many, the timescales that this has progressed to. But I think ultimately this isn't, creating new regulation for a product like this. You're not doing regularly. So to get it right, I think is important. So we'll be responding. And I think largely, having been through it, the draft consultation, I think it looks pretty sensible and, very much in line with what was issued back in the summer of 2022.
So it sounds like you're saying you broadly welcome it. You just almost want it to be faster, but
yeah, I mean, I've been very clear. I think for us, ultimately, I think regulation for these products, I think if you look at the past couple of years, what's almost been muddled at times and often in the media has been the regulatory standing of the products. So the fact that, yes, products at the moment that are short-term credits are under 12 months interest-free, they're not regulated at a product level and don't fall within the Consumer Credit Act. There are other rules and regulations that apply, whether that's financial promotions, contract terms, but specifically Consumer Credit Act doesn't apply to these products. Now, that has been muddled with, are these products good or bad for consumers? And do they drive are they helpful for consumers? Do consumers have good, outcomes using these products? So I think this step of, progressing regulation, I think will be a positive, because I think it will bring credibility to the products, but also then confidence to consumers ultimately. And having ultimately for a consumer, whether you choose Klarna in the checkout, whether you choose, an 18-month interest-bearing credit product in the checkout, or utilize your credit card, for example, I think to have the same protections, for example, if something goes wrong, so the right to refer your complaint to the ombudsman, absolutely a consumer should have those same protections. And they're protections that we can't give to our consumers until the regulation is in place. So again, that for us is why we've been keen for this to progress, because we've made lots of product improvements, where we haven't waited for regulation, but there are some where we are reliant on the regulation, the kind of rules to be in place to give those protections to our customers.
Yeah, it makes sense for all sort of consumer lending to be broadly equivalent in the way it's regulated. Amy, let's bring you in. What did you think of this story?
Yeah, I think the point you make, Alex, about bringing more confidence to consumers is an important one, and that will hopefully be an outcome of this consultation and the effective regulation that happens as a result of it. I think there have been quite a few developments recently from various firms around better reporting of customer information to the credit bureaus, and I know that Klarna has been involved in that along with others, and I think that move that the providers are making towards better, protections of customers without the need for the regulation, or sort of being proactive about it, is a really positive thing. And another story I was reading about the other day was the buy now, pay later provider Zilch working more closely with the debt charity Step Change as another really good example of a proactive move towards, buy now, pay later has potentially had some damage done to its reputation in recent months due to the press, but actually the whole industry is shifting towards a more having consumers' best interests at heart. So I think it should lead to positive change here for consumers.
Yeah, it's interesting, because I think all the way back to when Chris Willard issued his report, and I think the report was very good, actually, really thorough and really detailed, and based on data analytics plus kind of insights for understanding the products. But his point was very clear at the time to providers: don't wait for regulation. Get going, get moving. And if I think back, if you look at the market over the past 2 years, I think two areas. I think you're spot on, Amy. One area that's massively progressed is the credit reporting. That's been the bane of my life, trying to push that along over the past couple of years. A lot of work that's been required, to be fair, by the credit reference agencies to get that, the mechanisms in place, to get the product structures in place to accept, our customers' data so it can be reflected in their product, their credit file, and that they've progressed that now. We're sharing data now with Experian and with TransUnion. And then the second part, where again, I think the FCA have done a good job alongside the ASA, has been to kind of improve the standards of financial promotion, so marketing essentially, of these products too, and setting out, what their expectations are to make sure that it is, clear, it's fair, it's not misleading. And I think providers have responded. So much clearer checkout disclosures. Everywhere you look in a buy now, pay later ad in the UK now, it will say it's a credit product. So anyone who says, I was always a bit confused about credit products, understanding it's a credit product. Ultimately, when we asked our customers, 95% of them understood they had to repay it, and that's essentially their definition of credit. But that aside, in the question, do they understand it was credit? People obviously don't fully understand what credit means: credit versus debt versus borrowing versus a loan. But that is very clearly disclosed everywhere now. So I think there have been a lot of progress. I think the last step is to get some of the essentially regulatory or legislative protections in place. So Section 75, so sort of essentially buyer's protection that comes with most credit products, and then also FOS referral rights. And we went to the FOS. I've been to the FOS 3 times in the past 2 years to ask whether voluntarily we could essentially fall within their jurisdiction, because that is possible. But unfortunately, they weren't able to support that for various reasons. I would think, to be fair to them, the fact that they were aware this would be coming through regulation, so there's they've got to balance their priorities. But really happy that that's progressing, and now it's just keep momentum going ahead of this now much fated regulation day that they've referred to in their consultation.
Doug, how is this conversation playing out in Canada? Are you having the same kind of debates that we've been having in the UK and have been going on in many other markets too?
Yeah, I wish that one time when I come on this podcast, I could say that Canada is leading a conversation, but it appears as though every time I join it, I have to say, yes, we are doing this, but it's much slower and further behind. So again, this has been a point of conversation. Of course, I think where we are on that is we're not even at the point of regulation yet. We're at the point of kind of observing, and there are being arguments made towards this along the same line, like, please do not regulate buy now, pay later as if it were a credit card. We've seen an explosion in Canada with buy now, pay later. I think it topped just over $9 billion US last year, which was a pretty significant growth spurt. We've also seen like other players exit the market. So it's some frothy competition. I believe like Zip came in and dipped right out. But I think where we are, and this is a function of like relative to the UK and other markets around the world, we just do not have the infrastructure set up to quickly regulate, and we don't have the sandboxes to allow the innovation to easily play. Like we have no open banking structure here to allow sharing of consumer information that would make this easier, right? So individual agreements have to be signed. Like we're just so much further behind. So that this conversation is happening here, but it's at the I would guess the advocacy stage, while our Financial Consumer Agency of Canada is still closely monitoring this development. I wouldn't expect Canada to lead on this. We'll probably wait and see what drops elsewhere and then match that.
I don't think I've spoken to a Canadian in fintech or financial services in the past 2 years without them bemoaning the lack of progress on open banking.
I would say stay tuned. BetaKit might be running a story in the next week or so that will just reinforce how far behind we are. But I know we just ran a story yesterday on some information. Basically, like investment in Canadian fintech dropped almost $6 billion in 2022. So it has been a rough year and a half period for Canadian fintech. And again, we're still dealing with the same structural problems. So much of this would be happening so much quicker if we had the sandboxes, the frameworks, if open banking was delivered to allow that innovation to happen. Because to Alex's point, I think companies do not want to wait because they've been waiting for almost a decade now. So yes, we are having these conversations, but we're further behind. And I would say the Canadian government, when it comes to a regulatory standpoint, it really very much enjoys taking a wait-to-see approach to see what other markets do and then applying that. We're currently having that conversation right now when it comes to AI regulation, following the US's lead and trying to push forward our own bills.
Edwina, I want to bring you in because you haven't had a chance to chip in on this story. Obviously, you've got a lot of expertise in things like sort of affordability, know your customer, and so on. What do you think of this? Are you seeing sort of fraud problems related to buy now, pay later? What's your perspective on sort of regulation and buy now, pay later?
Yeah, so I definitely echo the others' conversation in terms of if there's not the regulation in place, there's going to be innovation that's caused by other things, either by commercial opportunity or by a pain point. In terms of fraud, again, it's the same fraud that's coming up across the board. And the biggest fraud issue is the first party fraud. So a customer buying a product without intending to complete their payments on it. And there's innovation that's happening on the fraud and identity side of things. So technologies and partners that we can work with and use to kind of get ahead of that initially. But the other innovation that's happening is more around trying to get access to more real-time credit data, so you can see people's behavior on a more frequent basis than like on a monthly reporting. So folks like ClearScore tackling them out with open banking, and other people trying to find ways of getting much more real-time access to the data.
Fantastic. Final word on the story, Alex? Final thoughts?
Yeah, I mean, I think ultimately the popularity of the products, and the shift in consumer preference is testament to the benefit of the benefit that customers see and the preference for kind of not just the interest-free nature of the products, but also the structured repayments are helping them stay out of long-term debt. I think all things being equal, fast forward 3-5 years time, once regulations in place, it's bedded in, hugely confident that this is the kind of path where preference is going to lie for consumers. And if you look at, for example, Sweden, where we've been operating now for 18 years, where we were founded, buy now, pay later represents roughly 25% of e-commerce payments. In the UK, we're still probably at around 5%. So there's still this kind of huge runway ahead of that we see kind of confidence there. Just interesting on that point, Edwina, about fraud. I completely agree. I think for third-party fraud, lower risk, because ultimately the SKU level data, so the kind of product level data and the consumer level data and understanding we can be quite confident that we're identifying the right person making the transaction. I think some of the challenges is that propensity to pay, and I think some of that we mitigate through incremental build-up of people's kind of credit, like what they'd be eligible for credit, if you see what I mean. So start them off with a very small kind of purchase value where they'd be eligible, prove that they can, they will repay before you build up to larger transactions, which again can mitigate the fraud risk. So again, I believe products are great. Let's work through the regulation, support the Treasury, support the FCA, and make sure consumers have got the right protections and feel confident to use the products.
Well said. Fantastic. Thank you. Okay, well, we're just going to take a quick pause here and we will be back very shortly. Hello and welcome
LFG people,
to
Fintech Insider,
Blockchain Insider,
11FS Spotlight,
11FS Explores,
Open Mic Night,
After Dark. Through our podcasts, videos, newsletters, and live events, we have a direct line to a truly global fintech community. So if you're looking to sponsor and collaborate on content that connects with everybody from fintech beginners to the biggest VCs, then chat to our team at sponsors@11fs.com or visit 11fs.com to find out more.
Long live the community.
Welcome back. Before we get on to the next half of today's news, a quick reminder to have a listen to the latest episode of our Fintech Insider Insights show. My colleague David Barton-Grimley is joined by expert guests from Pine, Proportunity, and Digital Cat Consultancy to discuss the possibility of a super app for buying a home. Would you use one? Have a listen to that wherever you got this podcast. Why not queue it up in your podcast app after this one? Right. Let's get into our next story, which is that Royal Bank of Canada has bought an AI-powered real estate company, OJO Canada. This was reported in Retail Banker International. RBC has acquired OJO Canada, a real estate tech company powered by AI, for an undisclosed sum. According to RBC, the acquisition reinforces its commitment to helping Canadians at every stage of the home buying process by providing logical, technologically advanced, and data-driven experiences and tools. OJO Canada offers a tailored real estate search, on-demand access to a network of subject matter experts, and the backing of financial resources, whatever that means. The firm, which is part of the US-based real estate technology corporation OJO Holdings, seeks to increase Canadians' access to the home buying process. Douglas, it makes sense to come to you first on this. RBC has been quite active in this area. They've done a number of different things. What does RBC's purchase of OJO tell us about the sort of Canadian market right now? Are fintechs feeling the squeeze? What did you think of this?
Let's put aside the market for a minute and talk about RBC specifically, because I think one of the more interesting conversations here is how when you bring smart tech-grounded operators into the bank, they can make moves. If you're not familiar with RBCX, it was a net new division created about 2 years ago when RBC poached BetaKit from OMERS Ventures, which is the venture-backed firm on one of Canada's largest pension funds. Been completely remaking the division, and I think this purchase was actually done through what used to be RBC Ventures, which was absorbed into RBCX. So this team handles all of their venture investments, their internal venture development division, and then making strategic purchases like this. I don't know if this would have been a purchase that RBC would have made 2 years ago prior to Sid taking over RBCX and looking at opportunities. So really interesting story there to see how one of Canada's largest banks has kind of changed their innovation stance by bringing some people in-house and kind of merging teams together. On the other side, in terms of the market opportunity, I think this is a pretty easy purchase decision to make, given that we are in a crazy housing crisis in Canada. Again, more good news. I'm just here giving great Canadian news all the time. Access to home buying at all levels in every province across this country is an existential threat. And I think we've seen other Canadian fintechs, prop techs in this space pivot. We broke a story recently about Properly kind of moving out of their home purchase guarantee and things like that. They're downscaling because of what's happened to the market here. I think this is a smart pickup by RBC saying we can buy this division. We can leverage, to our conversation before the break, all the consumer data that we have because we're one of the big 5 banks in Canada, and we can make this product more viable and a nice feather in our portfolio. So usually in downturns in the tech space, if you have a checkbook, it's a great time to be an investor and a buyer. And I think this is a reflection of both that, what's happening in the market, but RBC having the people on the ground to kind of make these moves and have the buy-in to make the purchase.
And just for listeners who are not familiar with the sort of home buying market in Canada, you sort of talked about the sort of crisis and this, what exactly is happening in the Canadian sort of housing market at the moment?
Well, we haven't built enough homes for like 25 years. And the speculative purchase of real estate in our two of our 5 largest cities, I guess you have 3 if you go Toronto, Vancouver, and Montreal, has been to the point that the federal government actually outlawed for 2 years the foreign purchase and ownership of net new real estate because I am podcasting in the east side of Toronto right now in this rental home that I will exist in until the end of my life because it is impossible to find anything on the market to purchase, and it's some of the most expensive real estate in the world, let alone North America. So that created a boom time opportunity for prop tech 2 years ago. But as the bubble has burst a bit, it's created a situation where these companies have looked to dramatically pivot because there's no inventory, there's little purchasing power, and the prices are such that they just can't find the deal flow. So again, not an issue for RBC. And something that they can probably cross-leverage with the rest of their customer data to take advantage of. But I just think it's a really smart deal for them.
Amy, let's bring you in on this. So, Doug was saying, hey, this is, a really exciting deal. Do you think we're going to see more consolidation in the market? Is this a sort of buyer's market for, companies that are, banks with capital that are looking to buy fintechs? And does it work? If you're a bank and you buy a fintech, do you end up, how do you make that succeed rather than just sort of squashing it?
Yeah, there are 2 ways from a bank's perspective in terms of do they absorb that brand of the fintech that they're buying, or do they keep that fintech brand separate and let it try to succeed under its own name. I mean, there's a story coming up in a little bit about Natwest buying a pensions fintech, for example, and there's always this question of will they just bring it under the Natwest Bank arm, or will they use it as also having acquired not just the capabilities but the brand as well? So I think it can just massively depend. The success can depend on how they choose to what approach and strategy they choose to take.
What's your view on this, Alex? I mean, I assume Klarna is not for sale, and you probably better not say if it is. But what's your view on fintechs being acquired by sort of big banks, big insurers, and so on? Can it work?
Yeah, I mean, ultimately, I always say the kind of trade-off when you think about sort of big bank versus fintech. Often you'll see, the winning formula is having the scale, so the kind of customer base that the big incumbent banks will have, and often the fintech will have the differentiator or the kind of the new innovation or the feature, and their challenge is to kind of get that out to scale. So that's often, it's the driver why so often fintechs themselves will reach a point where they're their own challenges. How do we scale this? How do we reach enough people? And acquisition or selling ultimately or being acquired by a big bank can be a route. I think Klarna, we've made like many acquisitions over the last couple of years, and our approach to Amy's view has been much more down the kind of absorb the brand in, so bring that capability in, and it very much what we've been looking at is kind of complementary capabilities that just add either almost like an extra feature or an underpinning capability that can bring value ultimately through to the end customer. So whether that's a new complementary product, whether it's our buying and underwriting capability. I actually joined Klarna myself through a business that we sold to Klarna in 2018. So it was a point-of-sale finance company in the UK. And it was, for Klarna, acquiring us as a relatively small player was just a very quick way to, massively accelerate their underwriting capability in the UK through the knowledge and skills that we had, build out their sales team in the UK almost overnight, and add an extra product in that we had the slightly longer term product. So, and I'm pleased to say many of us still are at Klarna 4 years later, which is great. But that, if you can get that right, and the fit can work well, I think Klarna is pretty tough and good in the sense that it's a very quick absorb in and kind of integrate it in very quickly, which I think sometimes these can go a bit wrong when you're not totally clear on how you are going to integrate it in, and then you get cultural differences within and pockets of different organizations within an organization, which I think ultimately doesn't work particularly well for long-term success.
Yeah, just one note to follow up here. RBC has been partnering with OJO in the Canadian market since at least 2018. So they had been doing trials, partnerships, development. So there was a specific relationship there. But to Alex's point, it is really interesting that in Canada you would see an acquisition like this done, and a big five bank like RBC look to keep the flanker brand identified, because again, we have such a limited competition opportunity here that many of the banks like using services like this and not white labeling them, but pushing that brand out there. It's something we also see in the telecom space. It's a entry point opportunity for new customer acquisition. But I think that's again, maybe to Alex's point, I wouldn't feel confident about this if it hadn't been RBCX making the acquisition. Like if it was traditional RBC 2 years ago, I wouldn't feel the same way, because I having worked at large enterprise companies and knowing that when we acquired startups, we were just watching them about to be ripped apart. It can be quite terrible. I don't think this is the instance because of the people who are signing the deal.
That's a really a great point, Doug. Edwina, I'd love to bring you in for the sort of last word on this story. Interested in your thoughts on the story, and also interested in if you've got a perspective on artificial intelligence, whether you're using sort of that at Alloy, and what you thought of this deal.
Yeah, we are not using artificial intelligence at Alloy, but we have a chance for our customers to do that and then pull that into our systems. So, but yeah, I think it's always impressive if you can pull off a successful acquisition and keep a strong brand. So Alex, it was just really impressive hearing the track record at Klarna. So it's not an easy thing to do.
Fantastic. Thank you. Okay, well, we will move on to our next story. I'm desperate to say that we've got a report on home buying that we're about to publish at 11FS, and we actually included a case study of RBC because of the really interesting work that RBCX has been doing. So I'm delighted by this story and can't wait for us to publish our report. However, moving on, our next story is that US fintech FIS is to spin off the Worldpay payments business. This was reported in the Financial Times. So the US-based financial services group FIS has said it will spin off Worldpay, the payments business it acquired for $43 billion just 4 years ago, after it failed to successfully integrate the two companies. So FIS acquired Worldpay in 2019 to create one of the largest providers of financial infrastructure that underlies the bank payments sector. FIS's decision to break up comes after activist shareholders D.E. Shaw and Jana Partners called on the company to review its business strategy, including considering undoing the 2019 deal. The idea behind the deal was to have the two businesses that would mutually benefit each other and generate more than $4 billion of free cash flow annually in an industry where bigger is considered to be better. However, the payments arm has struggled since FIS's acquisition, which has made the price it paid look steep. So, wow, how difficult is it to admit that a merger hasn't worked? Alex, I think I'm going to throw that one to you because you were sharing some good examples of mergers that have worked. Have you seen elsewhere in the industry, examples of mergers that haven't worked? How hard is it for senior executives to say, okay, we thought this deal was amazing and it just isn't?
Yeah, I'm just trying to think. We've seen some level of consolidation. If you look at the kind of Square, Block, Afterpay kind of consolidation that you see there, and like directly in our space, and obviously PayPal at various times have made acquisitions. I think, and obviously we saw Apple actually buy Credit Kudos. Actually, was an interesting one. We talked about that previously. Look. You go through. You've got to think when you go into an acquisition. You've assessed. Where you believe the economies of scale are going to be. I think what looks particularly odd in this case was the overlap of the customer base, and I think that's where this probably hasn't played out. In that you'd like to think that you're passing business or leads between two organisations, and you get this kind of that amplifier effect. 2 + 2 = 5, which clearly has appears to not be playing out here. If I think to why not, and you see it in the sort of the banking sector, almost back to that point we were saying earlier about, say, Klarna's model is kind of global product set and localized. I think you look at a lot of the larger banks, they are essentially just conglomerates of many different banks under one umbrella brand. And that's the point where you've maybe kept one umbrella and then you've got all these essentially local brands, all completely distinct kind of technology platforms. So, to your world, Edwina, they'd be using all different tools by different country and different market and different standards. You end up with this huge overhead, essentially, of complexity above that. So you end up having to employ more people to oversee the multiple platforms and the risk, compliance, all that kind of stuff. And hence you just don't get the kind of, ultimately you're adding more cost and, not necessarily realizing the revenue upside that you'd like to see. So I think that is, again, sort of testament to the approach that we've taken, which has been much more about acquire a specific product feature, a particular underpinning capability, a specific team. Maybe it's to accelerate entry into a new market, but then very quickly integrate in. If I think to PriceRunner, who we acquired, it's a large organization acquired last year. Acquisition went through in April. The capability in terms of, say, price comparison was integrated fully into the Klarna app within, branded as Klarna by October of that year. And that, very quickly then it just feels like an additive service or capability that your products get to benefit from. Not, 1 minute I'm in this app or this capability, the next minute I'm over here. How on earth does this join up together? And I think that's where these can sometimes go wrong.
What do you think, Edwina? Do you sort of agree with Alex's analysis?
Yeah, I do. I'm also fascinated by the kind of the personal dynamics that would have been at play here, like, to have this acquisition go through in the first place, the senior stakeholders that would have been involved, and having to walk that back actually shows some level of humility or like awareness as well, because quite often you can have projects that end up continuously being funded or continuously being pushed because of an ego at play within an organization. So I find that quite interesting to think about what's gone on behind the scenes here as well.
Yeah, it is. It's really, really interesting. Amy, let's bring you in. Can we think of other examples where companies have sort of come together and then realized it was not a good move? I mean, do you think this could be good for Worldpay in the longer run? Do you think FIS is a kind of a different type of business, right? Different customers, probably different culture.
Yeah, I think in the long run, inevitably it will be better for both businesses if they've got to a point where they've decided this is not going to work for either of us because of culture, because of customer base, because of multiple reasons, I'm sure. Then the fact that they're splitting apart is inevitably going to be better for Worldpay in the long run, I would say.
Douglas, let's bring you in. I'm curious whether you've talked to fintech founders with scars on their backs from mergers that didn't work, or whether you've seen any sort of similar deals where announced with great fanfare only to be unwound quietly, perhaps a few years later. What did you think of this story?
Well, does Twitter count as one? Like, I know that's not fintech, but I think we're watching that in real time, like a little bit of buyer's remorse. I would say, in the Canadian fintech space, again, because of the competition considerations here, oftentimes challenger banks, fintech startups don't have access to the payment rails. They don't have banking licenses. They often require some sort of partnership with the major banks here to even offer services or compete. So I think that is the source of the scarring more than deals gone wrong, because the incumbents have all the leverage. I do know there was a National Bank acquired a majority stake in Flinks, I think 2 years ago, and Flinks offers data sharing and customer information scraping, because again, we don't have open banking. And I think that's been pretty successful on both sides, because there's been a private open banking movement in Canada where the major incumbents are doing interesting acquisitions or partnerships there. I don't think we've seen anything as major as this where it's walked back, but I think Alex hit it on the nose before on what we were talking about in the previous segment. Like, is a really good example of how things can go wrong if you don't do the diligence, if you don't understand the ultimate intention of the integration of the partnership. And to Edwina's point, like if it's an ego thing, which you can see happen at large banks sometimes, where it's the home run swing to justify a share price or desire to get into a new market and not thoroughly thought through. I just keep going back to how this is the exact opposite of the OJO example that we were just talking about, where it's a multi-year partnership. They obviously knew at RBC how this was a net new customer value for them or offered a greater return for their existing customers, and they had the historicals for it. So they're able to pull the trigger there. I don't think they were swinging on hope there to hit a home run. And it can go really wrong if you're not doing the diligence.
It can indeed. Fantastic summary. Thank you, Doug. Okay, now for the section of the show called Big Click Energy, which is a quick-fire roundup of some of the more click-worthy news from this week. Amy, do you want to start us off?
Yes, so first story is that Natwest has bought a pensions fintech in a £144 million deal, which will shake up savings. And this is from City AM. So Natwest is to buy pensions fintech Cushion for $144 million in a move the bank says will bolster its offering of financial wellbeing products. The FTSE 100 lender said it would take an 85% stake in the London-based fintech, while the company's existing management would retain the remaining 15%. The chief of NatWest Wealth Business, Peter Flavel, said Cushion's disruptive proposition would support customers as they save for the future and manage their financial well-being. Cushion currently has around 500,000 customers and manages around £1.8 billion in assets for savers. The firm's chief, Ben Pollard, told City AM last year that its aim was to shake up the boring pensions market. My take on this, well, I was firstly interested in what it meant by NatWest will bolster its offerings of financial wellbeing products. It's quite vague, but I did have a look on Cushion's website because it wasn't a fintech I'd heard of before, but their proposition does have some really interesting elements. So the first thing that stood out was its app first. As the customer, you can see savings, investments, pensions via the single dashboard in the app. And I like how it's built around encouraging people to be more involved with their pensions. For example, you can change your contributions really easily. And actually, I think NatWest could do really well out of bringing something like this to its customers.
Yeah, I agree. And NatWest has a good track record of financial education in schools and so on. It's done a lot of work on that over the years. So good for NatWest.
Yeah, I mean, it recently acquired Rooster Money, the children's finance app that I think is now brought under its own brand. But that's a really good example of the sort of financial education piece as well.
Okay, and the next story is that Revolut has launched a donations page to support victims of the recent earthquakes in Turkey and Syria. So following the terrible earthquake that affected large parts of Turkey and Syria, Revolut has launched a fundraising page to support those affected by the natural disaster. Revolut has partnered with several charities in the UK and Ireland to make it easy for customers to donate to the victims of the earthquake. Through the donation section of their Revolut app, customers can donate to selected charities such as the United Nations High Commission for Refugees, the Red Cross, the Disasters Emergency Committee, Save the Children, and Action Against Hunger. They can then choose a one-off donation or establish a periodic donation if they wish to make regular contributions. And so I want to say I think it's fantastic that Revolut has done this. Revolut was very quick after the Russian invasion of Ukraine to enable people to make donations to Ukrainians who were displaced by the invasion. It's fantastic to see Revolut again moving really quickly to try and get help to people who really need it. It's a really good example of fintech for good. So fantastic work by everyone at Revolut who's made that happen. And I hope they're able to bring a lot of support to all the people who are suffering, the millions of people who've been affected by that and are terribly suffering. So great work. Well done, Revolut. Okay. Also, After Dark is back. We will be recording our Fintech Insider news show live at the Steel Yard in London on March the 29th. So if you're in London, Alex, Edwina, and of course many of our listeners, come and watch this podcast live with all the mistakes left in, but also grab some drinks, some food, and make some new friends across the fintech industry. All of the details can be found on the 11FS website and social media channels, or click the link in the podcast description. Okay, let's bring everybody back for the final section, looking at a more light-hearted story from the past week. which is that CIBC, Canadian Imperial Bank of Commerce, doesn't want couples to sugarcoat financial discussions this Valentine's Day. So the Canadian Imperial Bank of Commerce, known as CIBC, used Valentine's Day to draw attention to the connection between love and money with a new ad campaign. Creative agency Courage developed a series of conversation hearts with financial messages such as "Talk money to me," "Are you invested?" and "Let's consolidate." Instead of the more traditional romantic saying on the heart-shaped candies. I can't quite believe I'm reading this. The hearts were shared with influencers and given to employees and customers at the bank's flagship locations on Valentine's Day. Okay. How difficult is it to talk to a significant other about money issues? Doug, since this is a Canadian brand, I think I have to throw this to you first.
I just put two and two together and realized why I'm here, so that you could interrogate a Canadian about what the heck is going on with this. I would say, again, how am I going to try to be serious with this? I'm going to provide a layer of professional analysis because I'm a journalist and a professional. It's very difficult to talk about money in Canada. We are socially repressed when it comes to finances. And as a country, the vast majority of us live pretty close to paycheck and have a high debt service amount. So the conversations are not open. I think, we were talking about Wealthsimple previously, Canadian fintechs. Part of it's the response amongst the younger demographic, because they led with campaigns having open conversations about questions about money, finances, and things like that. So, good on the agency for convincing CIBC to have a little bit of fun at a time when the bank is making record profits. I would say, show me your portfolio would have been a great message. Open your portfolio to me. We could riff on that for days. Sorry, I can't provide any serious analysis to this. I apologize on behalf of all Canadians and most Canadian banks.
All right, should we try the ladies and see if we can get any serious analysis? Edwina.
I love this. Yeah, I think this is great. One of Melinda French's Gates' 3 most impactful things for gender equality is getting money into women's hands and into a digital bank account. So the more we normalize conversations about money, particularly at a couple level, the better. So I'm fully into the talk money to me, and let's get all digital banks, consumers on this message.
Fantastic. Amy.
Something I think is a really helpful driver of talking about money, even if it's at a very simple level. So I, for example, have a joint Starling account with my partner, and the fact that it's so transparent, and that if either of us spend on the joint card, we both get a notification to our phone, or I get one on my Apple Watch. And it means that, yes, okay, we're constantly spending money, we're using this account, but it's prompting those conversations and prompting you to be transparent, because the way that your bank is reporting the spending to you is very transparent. So I think that should help to drive a positive shift towards greater transparency.
I remember talking to a bank a few years ago about what their most popular alert at that time was the alert on the joint account that told you when your partner had spent money.
It can be really unnerving. If I'm away for the weekend and I get a notification on my watch saying that there's been some spending going on.
All right. So our last question is going to be, if you could send a love heart to somebody in the financial service industry, who would it be and what would the message be? Amy.
I feel like choosing one person is quite high pressure. So instead of just one person, I would choose my favourite fintech. And people in the team tease me about how much I love this fintech, but it's Plum, the savings and investments fintech. So if I had a love heart, I'd send it to Plum, I suppose, the leadership team.
Edwina, how about you?
I want to do the talk money to me to all consumer digital banking players.
Great stuff. Doug?
I'm inspired by Edwina's comment. I'm thinking about, I don't know her name, but the manager at my local bank branch when I was a university student, who sat me down to teach me actually how credit worked, and that putting my university tuition per semester on my starter credit card was a surefire way to ruin my credit throughout my 20s. She basically saved my life. I don't remember her name, but I would send her a box of chocolates at the very least.
And Alex?
So I chose mine based on the fact that this week we'd made progress on buy now, pay later regulation. So I decided to go for Alice Tapper, who is a personal finance journalist and campaigner. And she was the one who started the original campaign for buy now, pay later regulation back in 2020. I met her for the first time last year after lots of online chat. And actually, I think she's done an amazing job actually to raise awareness, for the need for regulation in this sector, but also for her view of the sector to evolve and to listen. And actually, when I met her last year in person, it was just really interesting because she was very balanced about seeing the benefits of the products, but equally, where additional protections can come to consumers. So I have so much respect for her in terms of what she's helped kind of prompt. And so I was looking at Love Hearts. Most of them have really wrong messages on. So I decided to go for You Rock, which was one of the ones I saw when I Googled, because I think she does rock. I think she's done an amazing job.
Thank you. Okay, well, that wraps up this week's news show. Thank you so much to my guests today. Where can people find out a little bit more about each of you? Amy?
It's LinkedIn for me, Amy Gavin.
Douglas?
You can read my works on betakit.com or check me out at Tron on Twitter while it still exists. Maybe check out our FinTech newsletter.
Edwina?
LinkedIn as well, Edwina Johnson.
And Alex?
Yeah, LinkedIn. So Alex Marsh or ADG Marsh. There's another Alex Marsh in America who's a porn star. So I use DG quite a lot as in my handles. Alex DG Marsh.
Well, that's awkward. Thank you. And as for me, Benjamin Ensor, you can find me on LinkedIn or at 11fs.com. And thank you all so much for listening. I hope you enjoyed the show today. Please join the conversation on social media or email us at podcast@11fs.com to let us know what you want to hear about. Thank you so much and goodbye.